Okay, so now we're going to keep going with this event. I have the honor of presenting you Diego Parrilla. Diego Parrilla is one of the greatest investors in Spain. He joined Quadriga in March 2017 after almost 20 years of experience macro commodity sales and trading in London, Singapore, and New York, where he managed risk and equipment in investments banks, prestigious global brands such as JP Morgan, Goldman Sachs, or Merrill Lynch. In these destinations, held positions of senior management as managing director, global head of commodity sales and structuring in London, head commodities Asia Pacific, established in Singapore, or management committee for Merrill Lynch Asia Pacific, among others. As I said, Diego is one of the greatest investors in Spain, and I have the honor of having him today here in this event. Diego, welcome. It's a pleasure to have you here.
Thank you so much. The pleasure is mine.
Okay, so I don't want to brag here. So with no further ado, Diego Parrilla. Go ahead, Diego.
Thank you, Ivan, and hi everybody. I'm going to support the discussion today with some slides, I'd like to cover a few very important topics, both on the macro outlook as well as the implications for portfolio construction. And these ideas are going to be linked to the concept of anti-bubble, which I coined. And let me start with a key concept that is critical and not well enough understood, which is the idea of false diversification. And I will continue then with the thesis and some key macro considerations for the next decade. With that, and being Spanish, you may, I'm using a football or soccer analogy. You may recognize the football pitch. I think it's very critical to understand that when we talk about portfolios, we're really talking about a team. And by that, we talk about not only how the players work on a standalone basis, but also how they complement each other. So in that sense, many of you who might be investors for your own money or professionally, you are the coach. You decide in a way what strategy you want to play, and the internal and external strategies, we are effectively players in that team. What's very important is that each player performs their job, their function. Otherwise, if everybody's running after the ball, it feels a little bit like a schoolyard. So in that sense, we need to understand that this game, both soccer or football, as well as the investment game, is in order to win, you must first not lose. And to do that, to me, the two basic rules of the investment game are first and foremost capital preservation, which is playing defense. It's avoiding these drawdowns, and then compounding on that capital preservation, which is the conventional offense. So what happens and what we've seen is that we've seen a number of instances where people have built teams that they have a lot of stuff in the team. They have a lot of things in the portfolio. You have some equity, some credit, some high yield, some commodities, some whatever. And you think you're diversified, but the reality is that when the crisis comes, it turns out that pretty much your entire portfolio was just one trade. We saw that clearly in recently in February, March 2018, but it's something that has happened over and over, as you can see, even in Q4. So what we see here is basically my strategy, which draws on the concept of the anti-bubbles, where effectively you're looking at a strategy that is playing defense when the team needs it. So it did look for a while like portfolios were diversified, but the reality is in these periods of stress and crisis, this is when this false diversification emerges. So very, very important to understand and not be fooled by false diversification, this perception of diversification, because it can lead to excessive risk and potentially big problems financially. So with that, I'm going to look into the concept of anti-bubble. Ivan already introduced me. Thank you for that. So in addition to my experience on the buy and sell side, I'm also a best-selling author. My first book on the energy side, co-written with Daniel Lacalle, was a bestseller, published in English, Spanish, Chinese. It's a very contrarian thesis, or it was at the time, with $120 oil and 200 peak oil theory. And we came with the thesis, the contrarian thesis of the flattening of the energy world, the convergence across energies, the convergence across regions, and 30 to 50 oil. These ideas, which sounded like science fiction at the time, have not only survived, the thesis has been reinforced, and it goes very much in line with this contrarian mindset of challenging the status quo and understanding the balances and imbalances in the system. That led me to write a second book of my own. This is the AntiBubbles. You can see an article that I published on the front page of the FT called Perfect Storm, Gold's Perfect Storm. And I'd like to borrow and just spend a few minutes discussing the concept of anti-bubble and then exploring the applications further. And I'd like to start by borrowing George Soros' definition of bubbles. He talks about bubbles as assets that are artificially expensive based on a belief that happens to be false, that happens to be a misconception. So effectively, the emperor had no clothes. So in that sense, what I've done as an engineer, I've generalized Soros' framework and argue that misconceptions can distort reality. But not only through artificially high valuations, which we call bubbles, you could also have artificially low valuations, which we call anti-bubbles. So in that sense, we're talking about assets that are artificially cheap. It's a matter of when, not if, that the value will go up. And in that sense, they could be some sort of extreme form of value. It's a matter of when, not if, that they will go up. The second dimension of the concept, which is very important, is the fact that bubbles and anti-bubbles are like distorted mirror images of a misconception. They're effectively two reflections of the same process. And from there, effectively, the moment when the misconception is understood and the bubble bursts, it's also the exact same moment that the anti-bubble reflates, because they are the same process. So I called it anti-bubble, a bit like an antivirus or an anti-missile. It's a defense mechanism against the bubbles. It's a perfect and effective hedge, both in terms of timing and catalyst. And the third dimension, which is very relevant as well, is this idea of risk premia, the fact that bubbles and anti-bubbles are not independent processes, they kind of feed on each other. So if we look, for example, at the relationship between the S&P and the VIX, what we see, and I would argue that they follow a bubble anti-bubble relationship, where artificially expensive or artificially cheap volatility can lead and support artificially expensive valuations. This is true both from a qualitative point of view, the complacency and the perception of low risk, mommy and daddy, central banks and governments, have our back, or the quantitative processes whereby CTAs or other strategies are buying, and their buying is effectively creating, reinforcing the trends, and the lower the volatility, the more buying. So these things tend to unwind pretty spectacularly to basically the realization that, when equities collapse and volatility explodes, or in fact, it could be volatility much higher that pricks in these valuations. So the key thing here is to understand, and the ironic thing is that the market is giving us the cheapest insurance when we need it the most. in January or throughout 2019, we saw the S&P at whatever 3,400 with the VIX at 10 or 11. So at that point is when you need the insurance, and the market is giving us the cheapest. Later on, when the market collapses to 2,200 and volatility is at 80, at that point, that insurance is less needed. So there's an element of being contrarian about this framework, which is important. And basically the idea of the anti-bubble, whether it's as artificially cheap assets that provide an effective hedge and an element of risk premia as we monetize and take advantage of these dynamics, it's important to understand what's happening. And the key thing here is to look for the beliefs or the misconceptions. So at the end of the day, based on Soros or our view, if you tell me the misconception, then we can find the bubbles and anti-bubbles. So in that sense, we see in practice how the strategy that we've designed, the goalkeeper of the team, has performed. And this is very important from a portfolio perspective. So again, we're not looking just at the individual merits of the strategies. In this case, we can see how the goalkeeper and the striker have both made money throughout time, significant amount of money. So one is up 60%, the other one is about 25%. So it's perfectly possible to make money through very different paths. Now, this negative correlation and the role of the goalkeeper is very relevant. And what you see here is a hostile market analysis. In orange bars, you see the worst months in the S&P since launch. And you see that our goalkeeper has been able to generate returns with a correlation of -1 during adverse and hostile markets, and to generate very significant returns. In contrast, when you look at the right-hand side, you see how that correlation is much lower. And in fact, and to some people's surprise, the strategy has been able to even make money during pretty bullish markets. Now, beyond this, I think I go back to the point of the team. I'm not claiming we're particularly smart or skilled. The thing is, we're playing a role. We're the goalkeeper of the team, and as such, that's our mandate. So when you think about building a team, and the starting point could be a neutral position of 50-50, 50% in defenders, 50% in strikers. Some people think, oh, I'm gonna buy 1% in goalkeepers. That 1%, even if you double your money, will not do much to protect against the 99% you have on the other side. So for me, 50-50 is a good starting point. And for many people, if your own wealth, your own business is risk on, in fact, the financial portfolio should probably be 100% in defenders and goalkeepers. So this 50-50 is just a neutral starting point. And what we see is what happens as a team. Effectively, the average return, or the return is the average of the returns, as you would expect. However, we achieved this return with a fraction of the risk, measured in terms of volatility as well as drawdown. In fact, the drawdown is so small that you could do what I call smart leverage, which is the idea of effectively, instead of having $100 in or euros in equities, put 80 in equities and put another 80 in defenders. So this is a leveraged position because $100 are effectively invested in 160, but by using to uncorrelated, or negatively correlated strategy, effectively what you're able is to reduce risk and significantly enhance the return. In fact, it's even better because when you think about, making money whilst you sleep, making money taking advantage of the volatility of the market, taking advantage of the stupidity of the market, if I may, what you do is this balanced portfolio, whether it's 50-50 or 80-80, over time will be 60-40, 40-60. So just bringing your position back to neutral. Just, okay, the market wants to pay this much for equities, I'll sell that and buy defenders, or the other way around. Just that passive approach, embracing the volatility and the irrationality of the market, could have made a very significant incremental return. In this particular case, over 15% whilst you sleep, right? So in that sense, it's not just about the merit of the individual players, it's how they play as a team, how we combine them. And what you see is that the team is better than the individual pieces. In fact, this becomes even more obvious when you look at, you know, the 80-80 team of strikers and goalkeepers relative to just the S&P. So I echo my first point on the mistake of false diversification. I stress the importance of true diversification, and to achieve that, you need to be able to invest in things that are effectively going to behave in a given way. The goalkeepers will do saves, the strikers will score, and that's the name of the game. So with that brief intro about the applications, let's talk a little bit about the macro outlook. And I'd like to break it down in two parts: the past decade, the next decade. And the past decade, I summarize in one sentence. It's the transformation of risk-free interest into interest-free risk. And what we've seen is effectively a period where, you know, once upon a time, we had the 10-year bond paying 5%, okay? This was great because two things. First, you earned 5% risk-free. And second, if there was a crisis and yields went to zero, your 10-year bond would pay you 50% capital gains. So it was not only a great way to earn money without any risk, it was also a great defender. But what we've seen ever since is how interest rates have gone, you know, all the way to zero, even negative interest rates. The zero interest rates have come obviously with money printing that has been lent, you know, to governments at first. So you print money as a central bank and you buy government bonds, and this nonsense of negative interest rates, which effectively tells you that, you know, $100 in 50 years you know, you rather have that money then than today, which is really against the rules of conventional rules of the game. But central banks have not stopped there. We've seen them buying credit, buying equities, you know, giving money away, what is known as helicopter money, just literally in people's pockets. And this idea that effectively you can print your way out of a problem. This is, you know, a fallacy. It's not true. If you try to print your way out of a problem, you're not solving any problems. You are delaying, you are transferring, you are transforming, and eventually enlarging the problems, as many of the Latin American viewers will know, or anybody who's experienced some of these monetary abuse. So in that sense, currency wars is critical to understanding that as central banks are trying to print their way out of the problem, what they're really doing is in some way artificially diluting their currency and creating inflationary pressures, both of which are desired outcomes, which is the reason why every central bank is doing this at as much and as fast as they can, and trying to transfer the problem to somebody else and transform it into problems. So either giving the problem to your neighbor through currency wars, or to your people through inflation. So with that in mind, there is a second part of the equation, which is fiscal policy without limits. We have seen countries like Spain or others being able to finance themselves at negative interest rates. You don't need to be a genius to understand that it's not a fair reflection of the fundamentals. It's 100% artificial, and it's simply that central banks are printing money and lend it to people at artificial rates, which allows them to spend at will. It allows them to increase their debt at will, and in some cases even to cut taxes, because this is like the miracle, you know. You can have this bail everybody out, spend as much as you want, increase the debt, and it looks like this is all just solved by printing money. This is clearly a fallacy, is not true. There are short-term solutions that might be needed, but certainly create problems in the longer term. MMT, modern monetary theory, is the greatest exponent of this belief, which again is not just me. There's many other way smarter people that are challenging including Warren Buffett recently, who's openly talking about the risks and dangers. And we need to understand that we live in a highly artificial world. So effectively, as currency wars take effect, other governments need to defend themselves, and currency wars it's a key dynamic that we'll continue to see in the future, because at the end of the day, if you devalue by 20%, my only defense might be to tariff you by 20%. So we're looking at this situation, with both monetary and fiscal policies without limits. This idea that you can print your way out of a problem, that you can borrow your way out of a problem. And when in reality, what we've done is we've kicked the can down the road and created really big problems. What someone would call the prudent imprudence, and measures that are very short-termist. So effectively, what we've done is we've had this very fragile situation, which I discussed in the book, and it's a case of what in economics we call pre-existent fragility. So the system's already very fragile, and then things happen. So in this scenario, where you're looking at abusing money and assets that you cannot print, in particularly gold, I think plays a very important function. I think there's a very strong view. My article in the front page of the FT with gold at 1,100-1,200 was calling for 3,000 to 5,000 gold within 3 to 5 years. We're on track for that. And this is basically part of a thesis that has accelerated. I'm particularly critical of a number of countries that look at this idea that you can 100% artificially set interest rates and exchange rates and effectively fix with lots of rigidity in the system. And I have been particularly vocal about some of the Babylistic dynamics in China, and how, in my view, this will effectively implode through the exchange rate. So lots of currency wars at play, lots of trade wars at play. They're very much interrelated. And that brings me to the last point I want to share, which is the next decade. And I would summarize the next decade as the transformation from bubbles that are too big to fail into inflation. We're looking at a situation where, as I mentioned, I think the damage is already done. We have this transformation of risk-free interest into interest-free risk, which effectively means that anything that is valued using discounted cash flows is giving you artificially high values. With if my maths are not wrong, with 5% interest rates, which is not that long ago, $100 in 10 years were worth just about 60. From a discounted cash flow perspective, those are worth 100 or even more today. So you can see how just by simply manipulating interest rates, you can create these artificially high valuations. And what's happened is we've created a situation where, as we know, we've had a shock without precedent in the form of COVID. This has, in a way, exposed a lot of the fragility in the system, and has resulted in a monetary and fiscal response that has been larger, faster, and with greater scope even than previous ones. So in this situation, and looking forward, I think that clearly there's a major disconnect between the economy in some way and the markets. This is the result of these artificial inputs in the system. I would argue that liquidity and debt will not solve insolvency. We are seeing already lots of cases, lots of zombies, lots of things that are in a situation where if interest rates were to normalize, they would simply implode. That applies to governments, to corporates, to households. So we're in a situation that it's not solving insolvency. It's just, again, kicking the can and transforming those problems. We can see how higher interest rates, it's science fiction today. They would just think about what would happen if interest rates were at 5%. The world would implode. In that sense, I've been saying for a while that the virus will go, but MMT will stay. So we'll continue to see extremely loose monetary and fiscal policies as central banks and governments, call for the fragility of the recovery. This has always been the same, where many of the temporary measures have become effectively permanent. We have this dynamic, which I'll talk about more shortly, which is the short-term deflation versus long-term inflation and stagflation, which I think is most likely the path that we have ahead of us. We have seen in the last few weeks how these artificial valuations may not last forever, and there's a lot of risk in the system. We've seen a lot of complacency, fear of missing out. There's no alternative, stock splits and all sorts of babulistic dynamics, alongside with obviously a lot of currency wars, starting with first and foremost the US dollar, which is trying to devalue and print its way out of the problem, and where I think real assets and gold in particular will be big winners. And we see this end game with potentially monetization down the road and inflationary pressures, alongside with more trade wars, which will those who abuse monetary and fiscal the most will be the ones that suffer the most, and volatility, which in my view will likely to remain quite high for the foreseeable future. So even with these historical high valuations now, and the VIX is still stubbornly holding above 20 and hovering around 30. So in that sense, let me talk briefly about the inflation-deflation debate. A lot of people, rightly so, say, Diego, how can you talk about inflation when we have unemployment and technology and demographics and overcapacity and bubbles and all these things that are clearly deflationary? And the answer is all these deflationary forces, this void of deflation is being filled by central bank printing at a speed and size without pretty much precedence. And this idea of the 2% inflation target, it's not a coincidence. It's not a random number. I talk about it as the frog in the boiling water. I talk about how we investors are I think everybody's familiar with the frog in boiling water, but I'll remind you, if you throw water in boiling water, it will jump. If you throw a frog in mild water and you just slowly heat it up, it will not jump. It will basically boil in the water. And I think inflation is a bit of the same. If you jump into Argentinian type of inflation, you jump. But if you're being diluted at 2% per annum, you may not notice. But within 10 years, this is 20% plus compounding, and over 20 years, you've been diluted to close to 50%. So, of course, it might sound like a long time, but the dilution power is huge. And don't fool yourself by the 2%. I mean, I think you don't need to be a genius to understand that official CPI inflation has nothing to do with my personal inflation or probably yours, and how these numbers are much higher. Clearly, behind all this, we have an issue with central bank independence. This was one of the key conditions to set up fiat currencies. And what we see, as per Voltaire, he said, paper currencies eventually converge to their intrinsic value, which is paper. So in that sense, if you lose the independence of central banks and effectively the government can control the printing press, whether it's Maduro in Venezuela or Trump, effectively they're going to use it and abuse it. It's just human nature, and it explains why every single currency throughout history has always suffered from this. So as I mentioned, we do have these deflationary forces, but be careful with inflation. I think it's, most important. I'd like to make the point that inflation is not about the value of your house going up or bread going up. Inflation is really about the value of the money with which you buy your house or buy bread going down. So think about the value of the money literally vanishing. And we're wired to think, oh, my 100 euros are worth 100 euros and they will buy me 100 euros worth. The reality is this 100 euros or $100, the purchase power is dramatically diminished over time. And this is something that could accelerate. So with that in mind, I think the rules of the game have changed. Once upon a time, we had a situation where basically central banks would operate under their mandate of financial stability, which was really inflation. So many people, some of the viewers and listeners will say, Diego, if inflation goes up, then interest rates will go up and bonds will go down. And the answer is, well, those were the old rules of the game. We're looking at a dynamic where interest rates cannot go up because the whole system will implode. And therefore, you have a situation where, in my view, we'll have both zero interest rates and high inflation, as effectively there's no other way to get out of this without, this is the preferred way for central banks, and they're crossing their fingers and hoping that these frogs, and the process will be contained, but the risk is building in the system. And clearly, my view is changing the rules of the game where we need to position ourselves. So with that, I will finish and summarize the presentation with the next 10 years. I think you are either long or short inflation. So when you think about what's going to happen and you build your team, we need obviously defenders, we need midfielders, we need strikers. But I think in this mindset of you're either long or short inflation, if you want strikers in your team, I think equities will be better than credit. At least the equities have maybe bread goes up, maybe wheat goes up, but the margin will continue. Whereas the 100 euros that your Telefonica bonds or whatever will pay you may not buy you that much. On the midfielder side, I think real assets like gold or real estate are clearly favored to cash. And I think on the defender side, be careful, because many of the government bonds, which once upon a time were great defenders, have lost a lot of their power. So anecdotically, or as a joke, I often refer to the German Bund as Beckenbauer. Incredible defender 30 years ago. He's now 74 years old. So the ability for the Bund to defend the portfolio is limited, and that's why we need to rely on the AntiBubbles. So with that, I'd like to thank you all for your interest. I think there's some questions, so I'll stop sharing the screen and pass on to Ivan.
Excellent, Diego. It's been a pleasure to hear you. It's awesome, this presentation. And yes, there are a couple of questions that we could cover. The first question, Diego, is what would you recommend me study to learn about options wisely? I think maybe this question comes because our audience knows a lot about you, and this idea of using a defender, this goalkeeper, maybe they won't understand how do you do that?
Well, look, I think there are multiple defenders you could use in the portfolio. Obviously, gold, I think, will defend you against certain bubbles, in particular the currency devaluation, the inflation. Fixed income, US Treasuries, I think, have still some defending power left relative to, because of the positive yields and perhaps where we're going. But tips, I think, are an interesting way to defend. But the question here is more related to options, which is one of the tools that we use and where we specialize. And options are really powerful defenders. whether it's both in terms of the insurance they provide as well as the volatility component. I've spent my entire career, learning about options. In fact, I did my thesis about something called real options, which valued real assets like a copper mine instead of the discounted cash flows as the right but not the obligation to extract this. And I was totally fascinated by options ever since. I mean, I had a professor at the Colorado School of Mines who basically said, look, a lettuce, it's a call option on a salad, right? So he was just saying you have the right but not the obligation. And this idea of anything in life is an option is incredibly powerful. So in that sense, I think there's intellectual papers or work like Taleb, you must read Fooled by Randomness, or The Black Swan. That this will give you a framework of thinking about probability and options. But then if you think about more technical books, there's plenty of things. Taleb himself is also an expert there. I think there's plenty of seminars and things. I would start with simple stuff and grow. I've given some seminars and things, but the one message I have to give is that don't be tempted by selling options. Okay, so make sure that you only buy options. And I know it's painful to spend the premium, and you go to sleep at night and you see how there's some decay, but at least you can sleep at night because you know your worst case scenario. Lots of people blow up because they think it's easy money. I sell the option, I collect the premium, these things will never happen. And then you get caught with a very leveraged position. I'll give you a simple example. If you were bearish Tesla, fine. I think it's been one of the best or most debated underlines in the market. But if you were bearish Tesla and you bought put options on Tesla, that's fine. You would have lost the premium. You were wrong. Fine. But some people say, I'm going to finance, and I use the quote unquote, I'm going to finance my puts by selling calls. And then you're dead because you're not financing anything. You're long puts and you're short calls. Okay. Absolutely. And if Tesla goes up 800% and you short calls on a levered basis, you blow up. So my point with options is don't try to be too clever. The idea here is you want to buy insurance. You want to buy insurance when it's artificially cheap, which is the case very often. But I would refrain from selling options because it creates open-ended risk and hidden leverage that could take you out. So start with Taleb, then look into the options, but stick to long for the foreseeable future.
Actually, I have to say that me, myself, I've lost a lot of money by selling options. So I have to revisit.
Me too. Yeah. Lesson learned.
It's a learn. Exactly. That's it. Okay. So thank you. I have another question that is, I'm going to redo a little bit the question because it has some similarities with the previous one. That is, what a retail investor, in this case, the guy say, what a retail investor like me might do to manage the risk in my portfolio? In this case, you have said something like that, but I'm gonna just give a little sense here that could be, as a retail investor, do you think it's a wise thing to use options or using, for instance, a fund to combine the portfolio with the fund or an index in, for instance, like a hedge, something like that? What is the product that you would use as a retail investor? To manage the risk in your portfolio?
Well, look, the first thing we need to understand is what's the risk, okay? And most people fail with the most basic thing, which is you need to think about the risk holistically. So you need to think about your job, your assets, your savings, your liquid investments, and when you think about diversification, you need to understand, is my job positively or negatively correlated to the economy, right? I've had some construction companies come to my office and they show me their liquid investment portfolio and it's loaded of high yield. And I go like, what are you doing? Oh, we're diversifying. It's like, dude, you're a construction company and this is high yield credit. So what happens if the world blows up? Well, my company will suffer a lot. What happens to your investment portfolio? Well, of course, it will blow up. But this mindset of long only, there's no alternative, it's the first point. So I would say, guys, think about the overall risk. Could I lose my job? What would happen to the value of my house, my mortgage, whatever? And so that's the initial point. In that sense, that will give you a sense of whether your financial portfolio should be more geared to more or less defense, right? But within the defense, I think you need to think about true diversification, right? And not even gold or gold miners will actually defend you with certainty in the short term, okay? Because it's very possible that equities fall and the market was positioned in a levered basis for gold, and there's forced liquidation and gold also goes down. So these correlations could be unstable. So even, the number one rule is don't use leverage. Okay, this is the single most important thing, because so first understand your risk. Second is don't use leverage. Think about the gold miners, right? Someone could have rightfully said, look, gold is a great defender. Gold equities are like a call option on gold. And I'm going to lever it 3 times so that I will have this amazing defender when the crisis comes. Well, guess what happened in March? $100 in a 3-time levered gold ETF on the miners went down to 5 to 7 cents.
Totally.
And what happens when you're already down to 5 to 7 cents or 10 cents, it doesn't matter. Even if you double your money the next month, you're still at 20 cents. Okay? If you hadn't been levered, you might have seen that loss of 30, 40% in the Delta One recover and be up in the year. But if you're levered, you're out. So you need to first avoid the trouble with understanding your real risk, avoiding leverage, even with assets that are negatively correlated. And then when you think about these assets, these defenders, again, you want to have diversification. I don't have a crystal ball. I don't know necessarily what the next crisis is going to do, but we know that there's certain predictable factors. Interest rates are likely to go down, volatility is likely to go up, risk assets are likely to go down, etc. So it's finding this portfolio. Now, things like the VIX are a good defender. Things like gold might be a good defender. Things like, obviously, S&P puts might be a good defender. The problem is they are often expensive and they have a lot of negative carry. So you buy your insurance and then they make it really, really difficult. So there's no easy way to do this. And you might say, okay, I'm going to buy some insurance for the next 3 months, but then, I lost money, I don't buy it again. And then things happen. So you want to be in a situation where, and this is what we specialize on as insurance experts, as options experts, we try to find the cheapest possible insurance with the most explosive payout, 5 to 1, 10 to 1, 20 to 1, with the lowest carry possible. Okay, ideally, options that will carry 0 or even positively. But it's not easy at all. Okay, so the strategies that we manage are trying to do this, and we're doing it for retail and institutional clients. But we are not meant to be just the only all singing, all dancing. We're one of the defenders of a portfolio. And we happen to be the best performing hedge fund in the world in February, plus 10%. We're up 46% in the year. We happen to be a great defender, but we're not the only one, and we are using an approach. There are many others. But funds, it's not an easy space. If you want to learn about options, you want to use it wisely and whatever, there are people who, like myself or others, have devoted our lives to options, and this is our mandate. So you should focus on the areas of strength. If your area of expertise, you're a doctor and you know a lot about medicine and stuff, perhaps you have an edge there, but maybe you should delegate to people on other fields, just like I would if I was going to have to invest in healthcare. I don't know where to start, or tech, right? So in that sense, I think the critical thing is, first and foremost, is avoid the trouble through investing in the wrong things, having too much risk, having direct leverage or hidden leverage. And then when it comes down to the options, be patient, think long term, and if you can, try yourself. And if you can, you may want to delegate. But I think the next 10 years will be very different from the previous 10. Whoever thinks that we're going to extrapolate this straight line in equities is up for, we'll see what happens. I don't know, maybe with inflation, but it's going to be volatile, lots of risks in the system. So I think prudence is good, avoid leverage, and do things that will create true diversification rather than fall into false diversification, or this temptation of selling options and catching carry that is not really rewarding you for the risk you're taking.
Great answer to be reflected deeply. So thank you, Diego. It's been a pleasure. Now, in a while, we are going to have the round table where you are going to participate. So it's value investing against the new economy change, hosted by Lorenzo Serratosa. So thank you, Diego. See you in a while. And nothing. I hope you guys, the audience, has enjoyed as I did. Thank you, Diego. Bye-bye.
My pleasure. Thank you, guys. Best of luck.